On this episode of the Hot Sheet, I discuss the continued decline in rents, housing inflation, and why economists are rethinking the recession forecast. Today is Tuesday, July 25th, 2023. I am Byron Lazine, and the Hot Sheet starts now. All right, 2 more days left on coupon code Jerome to get into BAMX. Of course, Jerome and the FOMC are meeting today and tomorrow to decide what to do with the federal interest rate. And we want to honor that decision by giving you 10% off of BAMX. You can use code Jerome to get 10% off BAMX, where you get all the daily downloads every day from the Hot Sheet. I think we have 3 daily downloads today, all in one place. You also get access to all of our courses, all of our live streams. I'm doing a live stream mastermind on Wednesday on online leads for real estate agents and our private community. So use the code Jerome to get into BAMX today. It's the lowest price likely you'll ever see. Speaking of low, rent prices continue to trend lower. This is something that we talked about yesterday and have been talking about since March. Barry Sternlet and others saw this way ahead of anyone else. Rent prices continue to decline year over year. This is a great news for inflation. If only the Fed and the Labor Bureau would stop using owner's equivalent of rent. That's making up 70% of the CPI. Okay, remember this from just a couple of weeks ago. The index for shelter was the largest contributor to the monthly all items increase, accounting for 70% of the increase. Okay, so this is when the CPI report came out just a couple of weeks ago. But remember now that that shelter, that owner's equivalent, makes up 25%. Shelter as a whole makes up 34% of inflation, but the owner's equivalent rent, which is a survey of calling up owners and saying, hey, what do you think your house would rent for if you would rent it? It's a ludicrous way to account for inflation in housing, but that's what they're doing. And so hopefully today, Jerome and the boys and the girls on the committee are going to say, hey, there's technology out there that shows us what real-time rents are. Let's take this into consideration as we discuss our next move. Now, we know that they're going to raise the interest rates. It's already priced in. It's happening, whether we want it or not. That's where they're going with it. All right. But in June 2023, the reality is the rental market continues to show signs of disinflation. In June 2023, the U.S. rental market continued to see a year-over-year decline for the second month in a row, down 1% for 0 to 2 bedroom properties across the top 50 metros. The median asking rent was $1,745, down $31 from July's 2022 peak, but still up by $7 from last month, and $339, 24.1% higher than the same time in 2019. Of course, we're not going to erase those gains, but you can see here the median rent year over year is on just as sharp as decline as it went up. In fact, it's even sharper than the increase that started in 2021. This is by unit. Okay, so the one bedrooms have probably dropped the most, or maybe the 2 bedroom. I guess 2 bedrooms have. National rent trend by unit size. So you've got studio, 1 bedroom, and 2 bedroom. These are all on a similar decline. Studio being holding ground the most out of the 3. Makes sense, right? National rents by unit size. Okay, so overall 1745 is the overall median rent. That's down 1% year over year. A studio is up 1%. So studios are actually up year over year at 1,445. A one bedroom, 1,630 is down 0.7%, and a 2 bedroom is down 1% at 1,945. We do not want to see rents continuing to increase. Again, I've mentioned it many times. You're going to see rent prices only drop further as the inventory in the rental market starts to hit in quarter 3 and quarter 4. Actually, I have a chart on that. I can throw it into the daily downloads. I'll add it. So if it's not there right away, it'll be there a little bit later. But look at this, total multifamily units under construction. We're at the highest level since 1970 to 1974. We've never seen anything like this on multifamily units under construction. Look at where we're at in comparison to the last real estate bubble. Okay. we're so far beyond that, and we've been beyond that for years. Okay. Right about here, what is that? 2014, 2015? From 2015, say on, we've been on an upward trajectory well beyond where we were building multifamily units in the real estate bubble. We have a glut of apartments coming on in a country where we need more single units for people to become homeowners. Okay, this chart is what they talk about when they use that dirty word renter nation. And a lot of reasons for this. We've made it easy for developers to build multifamily and hard on developers and builders to go out there and produce single family units in this country for sale, certainly at the affordable level. We're underbuilt between 2 and 7 million. Zillow's got us in the 4.5 million range of underbuilt, unaffordable single units for people who want to be a homeowner, who want to be 44 times wealthier on average than a renter. But this is where we're at, and you should see rent continue to lower. The fact that it made up 70% of headline inflation in the report, of the increases in the report a couple weeks ago, that it makes up over 34% of overall inflation, and that it continues to drop is another good sign that we are starting to beat inflation. Those numbers, of course, are from realtor.com. We can go into some local numbers on rent before I move on to overall housing inflation here. Big inflation week because of the Fed meeting. Code Jerome for a couple more days to get 10% off of BAMX down below. We can go into some local markets here on the realtor.com information. So if you've got a local market, just throw it into the chat and I'll pull it up. Metros with the highest share of young households, so age 25 to 34. These are the areas where you've got the youngest people moving in. I always think of Denver when I think of young people moving to a certain location. And what do you know? Denver's at the top of the list. Share of households. Denver area is at 18.9%. Share of households are 25 to 34. Median rent there is $1,984. And so the percent of income spent on rent is 26.7% there. Columbus, Ohio, share of households 18.4%. Median rent's only $1,200. Seattle, 18.4%, is in that 24 to 34 range. Median rent, though, there is over $2,100. Nashville, over 18%. You've got $1,678 on the rent. OKC, where's Jody from OKC, Oklahoma City? 17.6% for 24 or 25 to 34-year-olds, and the median rent is only $1,025. OKC, I'm a believer now that OKC is one of the most affordable places in the country for young professionals. Austin, 17.5%. Their median rent comes in at about $1,700. Dallas, 17.5% are in that 25 to 34 range, and their rent comes in at $1,541. Virginia Beach, 17.2%, $1,400. Indianapolis, 17.2% in age 25 to 34, and they're at $1,350. Indianapolis, another affordable area, and San Antonio, their rent's just under $1,300, where 17% of share of households are 25 to 34. Okay. Let's go to just year over year, 0 to 2 bedroom here. 50 largest metropolitan areas. Okay. Atlanta's down year over year, 4.3% on their rent. And if you have a location on this measurement, just throw it into the chat, on the live chat. Austin's down 8.6% year over year on rent. Charlotte's down 5% year over year on rent. Dallas is down 5.7% year over year on rent. Indianapolis is up 6.9% on rent. Makes sense. I mean, Indianapolis, $1,300. It's going to be competitive there, right? Las Vegas is down 6.6% year over year on rent. Milwaukee's up 7%. OKC's up 6.6%. They've got some room maybe to pop up at $1,000 average rent. Phoenix is down 6.1% on rent. San Bernardino, California, 5.6% down. Tampa's down 4.7% on rent. Good sign there. I think you're going to see some of these Florida communities pull back on rent, especially. A lot of these Florida communities, people want to be a homeowner. 4.9% down for San Francisco. And there you go. We'll link that down in BAMX and all of the downloads all in one place so you can get it easily. Okay. Let's take a look at housing inflation. Rental inflation is clearly down, but housing market rebound would pose a challenge for the Fed's inflation fight. Okay. This is in a Bloomberg piece. Home prices in the U.S. are again on the rise. When they say they're again on the rise, they're talking month over month. We've now seen 3 or 4 months consecutively, depending on what you look at, where home prices are increasing. Now, Case-Shiller just came out at 9 a.m. today, Eastern time, with their latest report, and they're showing year-over-year decline. We're going to get into that tomorrow, so make sure you subscribe to the channel so you don't miss it. We have Case-Shiller tomorrow. We have FHFA. We also have a interview with Robert Shiller that we're going to go over tomorrow. And then obviously the Fed's going to meet tomorrow afternoon. Thursday, we're going to be all things Jerome Powell. Coupon code Jerome, by the way. If you're not in BAMX, you get 10% off. That'll be the lowest price ever. So home prices are on the rise again, and on the rise after a brief dip last year. This is according to Federal Reserve's effort, or complicating the Federal Reserve's effort to contain inflation and raising questions about how much further policymakers will have to hike interest rates. Now, that shelter number is so much tied into rent that when they look at paid as significantly as rent is when we're looking at overall inflation. Doesn't mean that it's, good for home prices to get out of control. Jerome Powell wanted to break the housing market last year. He said it explicitly. He got rates in a position with the 30-year fix to be able to do that. We went into a housing recession. Now signals are that we are out of a housing recession, albeit with very low transactions. Okay. Demand, though, around the country continues to outpace our supply. A normal market is 6 months of supply, and we're at 3.1 months of supply, according to NAR, across the country. There are areas like the Northeast that are down to 2 months supply. Okay, so this is despite 7% interest rates. I think yesterday, we'll take a look here at where the 30-year is and where the 10-year sits today. But I think yesterday we ended the day at 6.99%. So we're just sitting here on this 7% number, and it's hard to get off of it right now. So this is from Torsten Sloke, a chief economist for Apollo Global Management. If housing begins to recover more meaningfully, that raises the risk that inflation is going to be more sticky. The real risk here is, meaning from the market's perspective, that the Fed has to step harder on the brakes, which means, well, the only thing the Fed can do to housing is continue to jack up rates to a point where the 30-year has to respond and goes and gets up over 7. Last year, our peak was 7.37. We got really close. We got 7.25 this year so far. Obviously, policymakers are going to raise the rate here again this week, and we'll see what the 10-year does in response. They've got it pretty much priced in, with over 90% of investors saying, yeah, the Fed is going to go ahead and raise the rate today and tomorrow, and announce that tomorrow at about 2 p.m. Eastern. We'll cover it Thursday morning. Inflation, of course, is cooling after a 40-year high last summer, but they're worried about it taking back off. Now, Bloomberg here, I'm giving shelter costs 34%. Bloomberg here says shelter costs count for roughly 40% of the CPI basket. I'm going off of what the Labor Bureau has here. Labor Bureau puts it, I'll find it. I don't know why they've got it at 40%. Let me find the chart here for Labor Bureau. They tell you what they weight this stuff at. Here it is. So shelter Labor Bureau has at this number here 34.67%. Okay. There's the owner's equivalent rent that I talk about that we should do away with, 25.497%, and rent of primary residence. And so maybe they're adding in some of those I don't know what they'd be adding in. Maybe like hotels and stuff. It's not in that category. Okay. Now if I don't know if you could see that. Could they see that? No. Cooper's not paying attention. They could see it now, but I don't know if they could see it before. So this is the 34% here. Here's the 25%. Now, if you remember this article that we went over from Wall Street Journal, if you measure it differently than inflation, it's mostly behind us. So if we measured inflation like the European style of inflation, it's called the Harmonized Index of Consumer Prices, the HICP. It doesn't include the imaginary, this is directly from Wall Street Journal, it doesn't include the imaginary cost of what a homeowner would pay to rent their house, because that's the measurement we use here on that big shelter data, is an imaginary cost. Hey, Mr. and Mrs. Smith, what do you think your house would rent for? I know you've lived there for 20 years. You're not in the real estate market and you've never tried to rent it, but what do you think it would rent for? Everybody thinks their house is going to rent for more than it does. I mean, they're taking a while. Oh, I heard the Joneses got $5,000 for their house. They're renting it for the summer here. I think we could get 6,000 because we've got better appliances than they do, right? People don't have an idea. Why don't we look at real time data? Apartments.com, rent.com, the realtor.com study that we just went over, or ask somebody like Barry Sternlight, who has 125,000 doors. Okay. So Bloomberg is saying 40% here, roughly 40% of the CPI basket. That's even better for the case. Okay. Bureau of Labor Statistics, which calculates the CPI, mainly measures shelter through the cost of rent, right? We just went over that number, including what renters pay each month, and an estimate of what a homeowner would be paying if they rented out a similar place. Rising home values can push up rents over time as landlords factor in what they could receive if they sold the property. Okay. Since these rents, this measurement that we're talking about is typically updated once a year, changes in prices and rents trickle into the official inflation metrics with a lag. So rents have been coming down now all year. You saw the chart on realtor.com. It's available for you in the daily download on BAMX. It's been happening, but we're still waiting for the lag on inflation. Okay. And that's just the situation that we're in right now. So housing inflation, I'm not worried about it. I don't see home prices running off substantially. We've seen a lot less mortgage demand throughout the entire year. We have incredible pent-up demand, especially for affordable housing. That's why at those median price points, you're still seeing 20 offers on certain homes. But when you look at the market overall, you do have less demand on single-family housings than you did last year. Okay, and so I don't see a scenario with these interest rates where they are, where home prices can get out of control. And that's why the Fed does want to see rates higher for longer. Okay. If we take a look at right now, just switching off of housing inflation and rent disinflation to the overall economy, there's all of a sudden more thoughts that the U.S. recession is not going to happen. The one they've been talking about for 2 years, that we're actually going to experience a soft landing. In Bloomberg, they reported that the U.S. recession becomes closer call as economists rethink forecasts. The Bloomberg survey shows firmer growth through the third quarter. Obviously, the Fed's inflation prediction there is 2%. Okay, so looking just into the future on this Bloomberg survey, they see a very strong third quarter, which delays recession once again. Remember, we had last quarter GDP, we were like blown away. The revision was even higher than expected. And that has pushed back any recession talks. There was a survey of 73 economists conducted from just a week ago, July 14th through July 19th. It was taken after that last CPI report, one we just referenced, showed the inflation rate slid in June to more than a 2-year low. That's the inflation report. Okay, so that prompted many traders to bet what's next. The Fed is likely to skip September after a July hike. You're starting to hear this more the last few days. We know that Bank of America, we looked at it yesterday, disagrees. They think there's going to be back-to-back hikes. Goldman Sachs is in this camp where they will skip September after this week's hike. The next opportunity in November will likely take place against a background of a recession as real rates become more restrictive. Okay, these rates, and Barry Sternlight talked about this in the piece we covered yesterday, where these rates are going to start to creep into decisions in the future, refinance, things that are going to be popping up. So there is some stuff coming down the line that we're going to have to deal with that we haven't felt with rates just yet. There is a reference in housing here from Duncan, Doug Duncan, who is the Dutch Bank chair, Fannie Mae chief economist, Doug Duncan. He says housing starts and home prices have been stronger than expected, providing the economy with support. Although we know last month housing starts went down. So when that comment was, we don't know. There's a video in here I'd love to play just on the CNBC survey. I don't know. I could play it, or if Bobby thinks he should play it. How do you think we should do that? I don't know if Bobby, I can go to it. It's the last link in the hot sheet charts. But this video was from this morning on the CNBC survey, talking about whether we're going to have a recession or a soft landing. I thought the survey was very interesting. And it was on Twitter. I mean, I can go to it. What is Bobby saying? Go on to it. All right, I'll go on to it. He's probably sleeping here. Let's go on to it and see if I don't think they're going to be able to hear that, though. They're not going to be able to hear it on mine. All right, he's sharing it. There it is. I can't hear it in my ear, so Bobby, if you can get the sound up.
Yeah.
I heard it for a second, then it went away.
Probability of a U.S. recession in the next 12 months falling at this point. And it looks like the stock market has already priced in a soft landing. That's according to the latest CNBC Fed survey brought to us by our very own senior economics reporter, Steve Leisman. Funny how, we go from recession to soft landing, and we all get on the same page. I guess maybe we should be nervous, Steve.
Yeah, maybe now's the time to worry. But the CNBC Fed survey showing markets expecting a hike this week, but seeing it as the last one in this cycle. And as you said, Joe, they've reduced the probability of recession below 50%. And that's for the first time in a year. Let's go through the numbers. 90% say the Fed will hike in July, but around 80% see the Fed still on hold in September and in November. The peak rate is 5.48%, call it 5.5%. And the Fed stays there for 9.5 months or so. The Fed is seen on hold until around March, when the chance of a cut just barely gets higher than the chance of a hold. A cut is more firmly built in, you can see, a year from now in June 2024. Meanwhile, the sentiment around the chance of recession shifting more towards that soft landing we've been talking about. The probability of recession falling below 50% for the first time since June 2022. Well below the peak you can see there of 63% in November, but it is elevated above the normal range, usually around 25%. So not all is well. Mark Zandi, though, writing in, inflation is receding, the Fed is near the end of its rate hikes, and recession risks are fading. Respondents are not fully embracing the soft landing. They're kind of in between. 42% of respondents say there's a 50% probability or higher of a soft landing, but 58% say it's less than a 50% probability. So they're kind of in that little bit of a limbo range there. Now, the group is generally bearish on stocks, so keep that in mind when I tell you that they see a soft landing already priced into equities. Just 20% say stocks are underpriced for a soft landing. 30% say prices already have a soft landing built into their prices, but 47% saying stocks are overpriced, even if there is a soft landing. Joe,
you can get rid of that, Bobby. Yeah. So obviously relating it back to stocks, trying to figure out where to put investors, where should they put their money, or are assets going to be up or down in the future? Should I put into stocks? Should I put into real estate? The big takeaway there was expect the Fed to hold firm for 9 months. Whether they raise or don't raise next month, remains to be seen on the next meeting in September. They're raising this week for sure, right? But then they're going to basically hold firm, not cut rates for 9 months. That would give me the indication that rates are going to be higher for longer, that we might not get to that 5.5% on the 30-year fixed that many have projected potentially by the end of this year. 5.9 is certainly in a lot of projections for the end of this year, going into 2024 spring market in the high fives. That would bring a real boom to real estate activity. It would allow homeowners today who are thinking about moving to move up, to trade up, because they're trading out of 3 to 5.5. Not as bad as going from 3 all the way to 7 or 7.25. Okay. But if we're going to stay firm for the next 9 months, that's into next spring market. When I'm talking staying firm, we're saying on the federal interest rate. So unless the relationship between the 10-year and the 30-year, we covered this on Knowledge Brokers Podcast, at Knowledge Brokers Podcast, with Chief Economist George Ratu, who went through and explained the relationship between the 10-year and the 30-year. If it starts to get back to a normalized spread, we've been at an abnormal spread here for a while, the regional bank crisis, which I don't think we're out of, right? Barry Sternlight yesterday said that you could see 400 or 500 more banks fail because of commercial loans that they're holding. But the bank crisis early in the year is one of the reasons that this spread is abnormal. We haven't seen it normalize yet. So we could see that normalize, the spread between the 10-year and the 30-year. And without the cuts from the Fed, you could potentially see the 30-year start to drop. We have not experienced that yet. We haven't seen that relationship between the 10-year and the 30-year start to normalize yet. So it all remains to be seen, but you could be experiencing higher interest rates for longer, which tells me you will be, as a real estate professional, experiencing lower amounts of transactions for longer. Not lower prices, but lower amounts of transactions for longer, if that were to be the case. Right now, today, the 10-year is back under 4, but it's over 3.9. We were over 3.8 yesterday, so we're up a little bit, actually. Here's what the 10-year's done in the last month. It's kind of just bounced around that 3.8 to 4 level. We can't seem to get out of it right now. We'll see how it reacts. We'll see how the 10-year reacts after tomorrow's announcement from Jerome Powell. The 30-year fix continues to hold firm at just about 7.0%. We're at 6.99 yesterday. Look how tight the last 3 reads have been: 7.0, 6.98, 6.99. On Mortgage News Daily's 30-year fixed daily survey, the 30-year fixed weekly is at 6.78, down from 6.96 the week before. We'd love to see a 10-year that starts to go low so that we can get some room on the 30-year fixed. Okay, if you have yet to do it, join me in BAMX. Use the code Jerome. Couple days left on that, 10% off of BAMX. Being a BAMX member also gets you into Bam Bash in Dallas in August. The Tom Ferry Summit in August, 22nd to the 24th. It's the Super Bowl of real estate events. I go every single year as a real estate agent. And if you're not going, we have a link down below where you can get the lowest ticket on the internet, $100 off your Tom Ferry Summit ticket. Use the code PRBAMSS. PRBAMSS. Let me know in the comments too, in the live chat, if you are going to the Tom Ferry Summit in August. If you're a BAMX member, you automatically get into Bam Bash VIP. That's going to be on the first night, August 22nd of the event. So you can get $100 off your Tom Ferry ticket. You get 10% off of BAMX right now, and you get into BAMX as a BAMX member, guaranteed. Last year, over 350 people didn't make it into the Bam Bash, but BAMX members are guaranteed entry into the Bam Bash this year. So hope to see you there. We'll also be announcing our Naples event for September in BAMX community. We announced it there first and release tickets to BAMX members first, where they get 25% discounts off of that. That'll be announced. If it wasn't announced yesterday, which I didn't see it go up, Jill and Eric will be announcing it today. All right, there's your hot sheet. Hope everybody has a great day. Tomorrow is the 2 p.m. announcement from Jerome Powell. We'll cover it on Thursday's show. I've got a bunch of Case-Shiller housing numbers and what it means to be year over year on a decline on housing prices since 2012. That'll be on tomorrow's hot sheet. Hope you guys have a very productive Tuesday. Until tomorrow, toodaloo.